Well, welcome everyone to this special Wednesday webinar. We typically skip August, but we wanted to do something on HR 1, also known as the One Big Beautiful Bill, to talk about the impacts on higher education. I'm Mila Tappan. I am the Education Affordability and Content and Training Manager, new title. And with me today is Jessica Whittier, and she's one of our fabulous education, affordability, and financial wellness counselors. So we are both so glad that you're here. I'm going to do the presentation, and Jess is going to watch the questions and answer them and feed them to me in between our sections. Excuse me. This session is being recorded, and the PDF of the PowerPoint and the link to the recording will be shared with everyone who registered for this session, and you can certainly share it more broadly if you would like. We do want you to ask your questions. I can't guarantee I'm going to have answers, but I will certainly do my best. So please put your questions. The Q&A is preferable because then we can track them a little bit more easily. So if you would do that, that would be great. And if I can't answer them, we'll research them, follow up in writing on them. And so with that, let's go ahead and get started. So here's what we're going to talk about today. We're going to talk about Pell Grants and FAFSA formula changes. We're going to talk about federal loan borrowing and federal student loan repayment. Those are two big topics. A little bit about negotiated rulemaking. We're going to touch on some 529 tax code changes, a few miscellaneous items, and we're going to conclude by talking about what didn't end up being in the final bill, because sometimes, we hear about things and we wonder, did that happen or did that not happen? And some of the big things I want to be sure that people know that they did not happen. So even with everything that we are covering today, though, I want to be sure you know that we are not covering everything that touched on higher education. We're really focused in on the things that we think will have the most impact on you and your students. So this is not 100% comprehensive, but I think it does touch on most of the most significant pieces. So I just want to do the quick disclaimer. This information is new. We are trying to get up to speed and stay up to speed as much as possible. But at the same time, there's a lot that we still need to learn through negotiated rulemaking and other guidance. So as of today, everything I'm going to share is believed to be 100% accurate, but bear with us as we learn too. All right, so with that, let's start by talking about Pell Grant and FAFSA changes. So probably you have heard about the fact that HR 1 did create a new workforce Pell Grant program. So this is exciting. I think, we'll have to see how it all works out, but I think we know that having programs like this and being able to get students trained quickly and have the money to be able to do that is incredibly important. Now, this is supposed to be implemented on July 1st of 2026. This is incredibly optimistic, this deadline or this date that they could start making these awards. So I'd like you to stay tuned because I don't know if it's going to be reasonable. I know that everyone would like to see it be, but we're going to have to hold tight on that. So when this is implemented, Pell Grants will be available to eligible programs that are between 150 and 599 clock hours, or between 8 and 15 weeks. They need to be offered by accredited institutions and lead to portable, stackable credentials. Programs must be approved by the state governor and align with in-demand jobs and meet employers' needs. Remedial, non-credit, English language learning, and study abroad courses are not going to be eligible for this funding. There are many additional requirements that do exist, and the details will be worked out through federal negotiated rulemaking, which will be held in December and January. So this is part of why I don't know that they're actually going to be able to get this going for July 1 of 2026, because there's a lot of things that need to be worked out, and we need negotiated rulemaking to make that happen. So a couple of other things I just wanted to mention, that the programs do have to have been programs that have been eligible for at least 1 year. The Pell Grant that students receive under this program will count towards their lifetime Pell Grant eligibility. So there's a limit as to how much students can receive in Pell Grants, and this will count towards that. Although they will not be able to receive a quote unquote normal Pell Grant and a workforce Pell Grant at the same time. And again, these institutions where students are taking these classes must be otherwise eligible for Pell Grants. So they have to meet lots of different criteria. So that's where a lot of these devils are going to be in the details, and we'll know more in the coming months. So Pell Grant eligibility for students with high SAIs. There's some changes coming to that. So here's what the current scenario is that currently a student whose family has a relatively low adjusted gross income based on federal poverty guidelines can qualify for a Pell Grant regardless of what their student aid index, what their SAI is. So even if the family has significant assets. So here's an example of that. If we have a family of four, because if you recall, 2 years ago when we started with Better FAFSA, they basically said people can get Pell eligibility by having a qualifying student aid index, but students can also qualify for a Pell Grant, a maximum or a minimum Pell Grant, based on only three things: based on the family's adjusted gross income, and the percentage of that based on the poverty tables, their marital status, and the number of people in the family. So, for example, we could have a family of four that is meeting that criteria. So they have an income, in this case, under 85,000. They'd be eligible for a Pell Grant. And it's not going to be looking at anything like their assets. So this family could have assets that are, $100,000 or $200,000 worth of assets, and have an SAI that's maybe 20 or 30,000. In this past 2 years, those families would be eligible, that student would be eligible for a Pell Grant. So this is trying to fix that scenario. There are not a lot of students that are impacted by this, but what it's basically saying is that students can still get their Pell Grant as long as their student aid index is not twice the maximum Pell Grant, okay? So even if they qualify for a minimum Pell Grant, it's going to take into account their assets, and they can have an SAI higher than it normally would be to get a Pell Grant, but it can only be as much as 2 times higher. So the threshold for the 26-27 year is going to be twice the maximum Pell, which is $7,395. So twice that is $14,790. Okay. So you might have a few students. I did have a few students this past year that had very high SAI, and they were getting a Pell Grant. So we'll see what happens next year, but I don't think this will impact a tremendous number of students, but you could have a student who was eligible in the past who is not going to be for next year. Another thing that was in the bill is that students will not be eligible for a Pell Grant if all of their aid, non-Title IV aid, like their state grant, their college money, private scholarships, for example, if all of those things are taken together equal or exceed the student's full cost of attendance, then the student will no longer be eligible for a Pell Grant. So this probably will not affect a tremendous number of students as well. Probably athletes are one of the ones that sometimes would run into this. But I think what I'm concerned about, or been thinking about related to this, is it really just changes the philosophy of the Pell Grant. So the Pell Grant has always been considered to be a first dollar program. So when a school is awarding financial aid, the first thing they're going to do is, if a student is eligible for a Pell Grant, they're going to award them that Pell Grant and then build on top of that. This changes that concept. This basically almost makes it look like the Pell Grant comes in at the end. So there's a lot of outstanding questions to be answered, and they will be answered through negotiated rulemaking. So stay tuned on this one. But again, we could have a limited number of students that could be impacted by this specifically, but also we want to watch what the impact is on the philosophy behind Pell Grants as well. Now, this is good news. HR 1 restores the exemption for family farms and family-owned small businesses, and small businesses are defined as those with fewer than 100 full-time employees from the SAI calculation. So when we went to Better FAFSA 2 years ago, families had to start listing their small family-owned businesses, their family farms. All of those were considered assets on the FAFSA, and there was a lot of pushback on that, especially out in the Midwest where there are lots of family farms. So they have revisited this, and they have decided that that exemption, they're going to put that exemption back on. So any of those families that you're working with who have a small family-owned business, they will not have to list the value of that business, as long as it has fewer than 100 full-time employees, in the asset section if they are required to provide asset information. Additionally, the exemption also expands to include family-owned commercial fisheries. As Jess asked the other day when we were doing a session, probably most of those were already covered under the small business exemption of fewer than 100 full-time employees, but maybe they just wanted to call it out specifically. I'm not sure. The good news is this change is effective with the 26-27 award year. So the 26-27 award year, the FAFSA is going to be released on October 1st. So it's coming right up. And to be honest with you, they're already doing testing. So this is going into effect. The FAFSA has already been updated to reflect that language that these exemptions are indeed back in place. So this, I think, is really good news for families in Maine because there were many, many small business owners. Another change that probably doesn't have a huge impact is that foreign income included in the adjusted gross income will now be used to calculate Pell Grant eligibility. So what's been happening to date is that when people are filling out their FAFSA, there's been a question because their AGI is typically coming over in that tax transfer, and they were being asked if any of that income was a result of foreign income. And if any of it was foreign income, it was excluded. It wasn't taken into consideration when determining a student's financial aid eligibility and SAI. So what's happening now is they're just saying, you know what, if it's in your AGI, it counts, even if it's foreign income. So the real benefit of this is probably not going to affect many students in terms of they didn't have foreign income, but it's a question that's on the FAFSA, that's been on the FAFSA for the last 2 years. It's going to come off the FAFSA. So if anyone's been through the FAFSA and you get to that question, you're like, what is this even talking about? The good news is that question is going to be gone altogether. And people who do have foreign income, it will show up in their AGI and it will count when their financial aid eligibility is being calculated. Okay, so that's what I had for Pell Grant and FAFSA changes. So not a huge number, but obviously Workforce Pell is going to be the really big one that we're going to want to keep an eye on. But I'm not seeing any questions, Jess, so I'm going to push forward. All right, now let's talk about federal loan borrowing. This is one of the areas where the changes are significant, specifically for graduate students and some parents. So let's dive into this a bit. So currently, parents can borrow up to the cost of education minus the total amount of other financial aid the student is receiving in a Parent Plus loan. So for example, if a student is attending a school that's, let's say, $70,000 per year, and let's say the family, is fairly well off, so they've got a high SAI, and the only thing that the student is eligible to receive is a $5,500 unsubsidized loan. The parent, assuming the student did want to borrow that loan, the parent could borrow the difference between the $70,000 and that $5,500 loan. So what's that? $64,500. So parents at this point can borrow a really significant amount of plus loan, depending on the cost of the school and the other financial aid the student is receiving. HR 1 is trying to address that by saying that parents can only borrow $20,000 per year per dependent student. Okay, so it's going to limit within an individual year a parent's borrowing to $20,000. Now, this is per student, so if they've got multiple kids, they can borrow up to $20,000 for each of those children. HR 1, the House version was a little bit different. Now, what's interesting is that the aggregate is $65,000 for that particular student, though. So a concern I would have is just for families to be aware of the fact that if they're borrowing that $20,000, they can borrow that the first, the second, the third year, but when they get to that last year, they don't have $20,000 remaining. They're only going to have $5,000, or they're going to hit the aggregate. So this is something that we're going to want to keep an eye on and work with families on explaining how this is going to work. Now, the good news is, I think it's good news because we wouldn't want families to get too caught off guard, is that there is an exemption for up to 3 years for parents who borrow a plus loan before July 1st of 2026. Okay, so almost a year from now. So this is basically being called a legacy exemption or grandfathering, whichever term you would like to use. But if a borrower has a federal direct loan, in this case the plus loan, and it was made before July 1st of 2026. While the dependent student is enrolled in a credentialed program, the parent can continue to borrow under the current loan limits for 3 academic years or the remainder of their dependent student expected time to their credential, whichever is less. So the idea is that this is going into effect now. So we might have a family that's going to borrow in this upcoming year, but then their student, if they're in a 4-year degree program, is still going to have 3 years left. Because they borrowed before July 1st of 2026, this does not apply to them. They're going to be under the old rules, which is the cost of attendance minus other aid with no aggregate limit. Okay? So there is that provision to allow those that are already in the system or who borrow in the upcoming year still have access to a larger amount of PLUS loan. Okay? So any questions about that, put those in the chat, and we'll talk about it more if need be. Now, one thing I did want to mention that I haven't put on this slide, but those of you who are working with parents who are PLUS loan borrowers, when we get into repayment stuff, which we're going to touch on in a moment, it does get a bit more complicated as to which repayment options are going to be available to them. So I'm not really going to touch on that today, but I would say if you are working with parents who do have PLUS loans, be sure that they reach out to us or to someone who knows kind of how this is all going to work as they make their decisions about borrowing, if they're going to be borrowing specifically after July 1 of 2026. All right, now let's talk about graduate loan limits. So you can see all of these. I've tried to put the date of enactment. It's different for different things. So these also go into effect. This rule also goes into effect on July 1st of 2026. Currently, a graduate student can borrow up to $20,500 in a federal direct unsubsidized loan annually. So you think about our undergrads, it's 55, 65, 75. For our graduate students, it's been 20,500. Okay, all grad students. HR 1 is going to maintain that annual loan limit of 20,500 for graduate students, but it's going to set a higher amount, 50,000 per year for professional students. So in a moment, I'm going to talk more about professional students, and then I'm going to talk about Grad Plus going away, which is why they're increasing the amount that students can borrow in a regular federal direct unsubsidized loan. Okay, so bear with me and we'll get to those. Thought about rearranging, but I still think this sequence makes the most sense. So for those graduate students, again, this is after July 1 of 2026, they will have an aggregate limit of $100,000 for a graduate student. So those who are able to borrow $20,500 per year, their aggregate will be $100,000. And for those students who are considered to be professional students who have access to $50,000 per year, their aggregate will be $200,000 per year. This does not include what they borrowed as an undergraduate. So this is what they're eligible to receive at the graduate level. So now let's talk just a little bit about who's going to be considered a professional student. So professional students are ones that typically require licensure. So think medical doctors, lawyers, but not most PhDs. So someone who is going to get a PhD in English would likely be, we've got some things to be figured out, but every indication is that they would only be eligible for the 20,500. Okay. But medical doctors and lawyers would be eligible for that higher $50,000 amount. So here's what we know right now is that HR 1 referred to this definition that's in the Federal Code of Regulations as to what a graduate student is. So they, a professional student is. So they call out some professions specifically. But the reality is we need to wait till negotiated rulemaking to find out for sure, because there are others that are representing, one of the ones I've seen is social workers. And they're saying, these are professional degree programs. And so they're kind of wanting to get in and have access to the higher loan limits. So negotiated rulemaking, which I'm going to talk about in a few moments, will deal with that. And we'll have more clarification as to the definition of a professional student once that has been completed. But this gives you some indication of who almost definitely will be included. And the reason for the increase for professional students is that currently students can borrow a Grad Plus loan. And so a Grad Plus loan is very similar, almost identical to a Parent Plus loan. And it allowed students to borrow up to that total cost of attendance minus their other financial aid, which would have included their $20,500 federal direct unsubsidized loan. As of July 1 of 2026, this is going away completely for new borrowers, okay? So this will not be an option. So if you think about our students who are, maybe going through their undergraduate education right now with dreams of going on to become a doctor or a lawyer or some of, those types of degrees that are high cost degrees, they are going to be limited, assuming that they're a professional program, to $50,000 per year. So this has really significant ramifications because if you think about even some of the lowest cost medical programs, they far exceed $50,000 a year just for tuition and fees, not to mention the other expenses that can be taken into account, like their housing and their food and their books and their supplies. So I think there are many, many people out there who are concerned that, lower income students, are they going to be able to pursue these types of degrees? One of the ways that this gap might be filled is through private lending, but private lending is very different because it requires that people go through a process where there's a debt to income ratio typically. And so, that's going to mean that not everyone has access to people who can co-sign loans for them. So that's concerning. The other thing is, and I think this is some of what was behind it, is that these loans, these federal student loans, these Grad Plus loans could theoretically have been forgiven through public service loan forgiveness. If these students are having to borrow in addition to what they can borrow in the federal programs, if they're also having to borrow through the private programs, those programs will not be eligible for public service loan forgiveness because they're private. So there are lots of things that we could talk about in more detail here, but this is definitely an area where we're having conversations with schools here in Maine that have graduate programs to figure out what options are going to exist for these students. Now, just like there is an exemption for those in the Parent Plus world, there is an exemption, or a legacy provision for same thing for up to 3 years for students who borrow a Grad Plus loan before July 1, 2026. So I never will encourage people to borrow, but one thing I do think we want to be aware of is if we have students who are starting grad school this coming year, if they think they're going to need to access higher amounts, especially if they're only eligible for the 20,500 or they're in a very expensive program, they may want to consider, even if they didn't technically need to for this upcoming year, they may want to consider whether or not it makes sense to borrow through this program just so that they can take advantage of that legacy provision if they need to. Okay, so again, never wanting to student to borrow when they don't have to, but there is this thought in my head about preserving their eligibility for upcoming years just in case. Now, there is a lifetime limit on all federal student loans. So HR 1 contains a provision that says that the maximum amount that a student can borrow is $257,500. That is the maximum. And not all students would be eligible for that. So that would be basically the students who borrowed $200,000 as graduate students, plus the maximum that can be borrowed as an independent student who's an undergrad or an undergrad whose parents are denied a plus loan. The maximum there is $57,500. So that's where that number comes from. It's the maximum amount that a student could possibly borrow at the undergraduate level, plus the maximum amount that a student could borrow at the graduate level. So again, not all students would be eligible for even this amount, but that is the maximum. And this limit includes amounts that have already been repaid. So there had been in the past, if you repaid some of your federal student loan, you basically could go back and reborrow that if you were up against the aggregate maximums. But that is not going to be the case. This is the limit. That's all you can borrow, even if you have repaid some already. But if a borrower has borrowed under the federal direct loan program before July 1st of 2026, they can continue to borrow again for up to 3 years, depending on how much longer their program is. So again, that grandfathering provision. And then just one more thing on loan borrowing that I want to talk about is loan proration. So institutions will be required to prorate annual loans in direct proportion to the percentage of full-time status for which the student is enrolled. So what does this mean? Currently, a student If they are taking 6 credits, they have to be taking at least 6 credits in order to be eligible for a loan. But if they're taking 6 credits as an undergraduate, that's usually considered half time, but they can borrow the full amount of loan. So if a student is a first year student, and so they'd be eligible for 5,500, but they're only taking 6 credits, they could still borrow that $5,500. So this is saying that that's no longer going to be the case. It's going to treat it more like Pell Grant is treated, which is the amount that they can borrow is going to be prorated to reflect their actual enrollment status. There was no date stated in the bill as to when this would go into effect, so there has been some concerns that this was going into effect for this academic year, but NASFA, which is the National Association of Student Financial Aid Administrators, an organization that we rely on tremendously for financial aid regulation interpretation, has confirmed with the Department of Education that this proration will be in effect for the 26-27 academic year, so not this upcoming year. So there's some time for schools to figure this out and to implement this. So this will not be going into effect immediately, but it will be next year. So we want students to be aware of that, because some of those students, have been relying on being able to get that extra amount of loan for their living expenses and some of those other things above and beyond their tuition. So yeah, their tuition is less, but they might still have these other expenses. So we want them to be aware of that change. There's no there's no legacy provision with this as far as I'm aware. So this could affect them next year. All right, Jess, before we move on, sorry, any questions? I'm not seeing any.
Still nothing. You are doing amazing.
I don't know about that, but doing my best. So thank you. Okay, now we're going to get into student loan repayment. So this is going to test me a bit more. I'm still trying to get this like cemented in my head. But we're going to start with the most basic changes. So it will get a little bit more complicated as we move along. But basically, what's going to be happening is that repayment plans for new borrowers, so continuing on, this would be after July 1st of 2026, they are going to have limited repayment options. So, we've lived in this world where there have been so many repayment options. I think many of us feel like too many because it's so confusing and students didn't know how to pick. So this is being addressed. And so we're going to see how it goes, so that basically new borrowers, imagine those students that are in high school now, aren't starting college until after 2026 or July 1st, they will only have 2 ways to repay their student loans. They will have a new standard repayment plan that's going to have fixed monthly payments. So currently, it's going to be updated, but currently there's a standard repayment plan. It was a 10-year plan. Your first payment and your last payment are the same amount. They take the whole amount, they figure out what the interest would be, and your payments are equal for each payment, having nothing to do with your income. Then there's going to be a new income-based plan, and it's going to be called the Repayment Assistance Plan, or RAP, okay? So this will be the one plan that will be available to students who are new borrowers after July 1st of 2026. This will be the only option available that will be tied to their income. So they'll have a standard repayment option, and they'll have a repayment option that is based on their income if they choose to go that route. Now, all loans, though, this is a caveat, all loans must be paid under the same repayment plan. So where this gets a little bit tricky is that if I'm someone who does all of my borrowing before July 1 of 2026, we're going to talk about you in a moment. Even though we're talking about new borrowers who will be borrowing for the first time after July 1, we actually are also talking about those borrowers who maybe have already borrowed, but will be continuing to borrow after July 1 of 2026, okay? And that's because all loans have to be repaid under the same repayment option. And at that point in time, because they're borrowing a new loan, so it's really not just new borrowers, but new loans after July 1 of 2026, their options will be the new standard repayment plan, or RAP. Okay. So let's talk about the standard repayment plan, the new one that's coming. So this new standard plan will have 4 fixed terms, depending on how much the student has borrowed. So unlike where we have been to date, which is basically it was 10 years, whether you borrowed $5,000 or you borrowed $150,000, it was a 10-year repayment plan. This is acknowledging that sometimes debts are higher and the amount borrowed is higher, so it's stretching it out to make payments be a little bit more reasonable under this plan as well. So for those students who borrowed under 25,000, they're going to continue to have that 10-year repayment plan. If they borrow between 25 and just under 50,000, they're going to have 15 years to pay. If they borrow between 50 and just under 100,000, they'll have 20 years, and then over 100,000, they will have 25 years to repay their loans. But again, their first payment, their last payment, their middle payments will all be approximately the same amount, okay? Because it doesn't have anything to do with their income. It is literally just like any of the other loans that we typically take out, car loans and mortgages. They'll be treated just the same way. And then there's RAP. Yes, Jess, did you want to say something?
We just had a question about that from somebody. Do you want to wait until you're done this section?
I'll take a peek at it.
So there, Maria's asking if the repayment plan, the new repayment plan means that consolidation is not possible between loans prior to July 1st of 26 and loans after.
So I am not going to go heavy duty into consolidation. I will tell you it starts to get really complicated, and there's some discussion of whether there's even some conflict in the rules. So basically, if someone consolidates after July 1 of 2026, they are limited to, as that's a new loan. So their only options are going to be standard or RAP. They consolidate before that, we're kind of going to get into that in a moment. So, Maria, if you want to talk about that in more detail, I'm happy to, go into the weeds a bit more as I understand it. Probably will require me to look up a few things to verify it too. So don't hesitate to reach out, or anyone on any of these things. If you after the fact have a question, send it my way, and we can chat further about it. But consolidation, I'm going to kind of stay away from that today. All right, the repayment assistance plan. So this is going to be the income-based repayment option. So payments are going to be based on the student's income, and it's going to be based on their adjusted gross income and their family size. Now, this is very different than what it has been in the past. The payments in the past have all basically looked at the income, but it's assumed that a certain amount of their income was protected, and then based on that, that's what would determine, the amount of their discretionary income would determine what their payment was going to be, and it was a percentage. So this is a whole new calculation. So basically, how this is going to work is the more people earn, the higher portion of their income will be expected or will impact their loan payment amount. Okay. So if their if their income is less than $10,000 per year, their payment is going to be 120. So when I looked at it this first, I'm like, well, down below it says, that someone with $10,000 in income would only pay 1%. But jump down to the bottom for a minute because the minimum monthly payment amount is $10. So $10 a month is the minimum. Everyone will have at least that amount, which is different than save. We've all kind of learned about save over the last couple of years. Save is just totally going away. But that did allow for zero payment, but this plan does not. So everyone will have at least a $10 a month payment. And then as their income increases, the percentage increases. So, someone who's earning, $60,000 to $70,000, 6% of their AGI is what their payment amount would be. So conceptually, it's really simple. And I think that's part of what they were going for. A person, if they know their income, they can basically figure out what their payment amount is going to be. The research done on this says that, as I've understood it, says that for those who borrow under 80,000, this is actually a really, a pretty affordable plan. There's some other good benefits that I'm going to talk about in a moment. Once income gets higher, then this plan is a more expensive plan than what we have existing currently. Save was always more affordable than anything. But when we look at pay or IBR, this is pretty comparable and even better in some cases for those on the lower income scale. That's what the research says. Okay, so a few other things about the RAP plan. If a borrower is married and filing separately, so they file their taxes separately, then the spouse's adjusted gross income and the number of dependents will not be included in the payment calculation. So there have been different different repayment options in the past where if you were married, even if you filed your taxes separately, your spouse's income was counted when determining your loan payment amount. And so this is not the case with RAP if you file your taxes separately. So whether a married couple wants to file their taxes separately, that's got a whole other set of things that they want to look at and take into consideration. But if they do decide to file their taxes separately, then their spouse's income would not be taken into account. A good thing here, this is kind of called the interest subsidy. If the monthly payment is not enough to cover the accrued interest, the interest is waived and will not be added to the loan balance. So this is a really good thing because, what we've heard about with student loans in some cases is people might be making payments under past plans. And even though they're making their payments and they're doing what they're supposed to be doing, their loan has been growing. And so this plan will prevent that from happening because as long as they're making their payments, any additional interest will be waived. So that will no longer happen. There's also a principal subsidy. So if a borrower makes an on-time payment that reduces their principal by less than $50 per month, so imagine someone who has a low income but a high loan balance, so their payment, is such that their principal is less than 50 is being reduced by less than $50, then the Department of Ed is going to reduce the outstanding principal balance by up to $50. So hopefully there's progress being made. That debt is being paid down, even if the loan amount that they're required to pay is very small. Okay. There are some things that need to be worked out on this through negotiated rulemaking. So we'll talk more about that in the moment. And Jess, I see there's a question. Let me continue on and then I will grab that. Okay. A little bit more about RAP. There is no cap on monthly payments, even if the payment amount is higher than the standard repayment plan would be. But the good news is they could, if that was the case, they could switch into the standard repayment plan. There was a point in time with the House bill where people were not able to switch out of the repayment assistance plan. They were actually referring to it as the TRAP plan, but that was changed. So they can still switch from one payment plan to another. The maximum repayment period is 30 years, so this is longer than any of the previous plans. So basically, if people are making their payments, this would probably be the case for people with very low incomes and fairly high balances. If they were making their payments, but after 360 qualifying monthly payments, so 30 years of payments, then what's left would be forgiven. At the moment, that amount though would be treated as taxable income. Okay, there has been a provision temporarily where that was not the case, but that's going to expire unless they take action. Now, if they're doing public service loan forgiveness, and their loan is being forgiven under that public service loan forgiveness, those amounts that are forgiven are exempt from federal taxes. Now, not going to go into this a lot because I said the repayment stuff starts to get really complicated with parents, but new Parent Plus loan borrowers aren't going to be eligible even for RAP. So if you've got someone who's going to borrow a Parent Plus loan, and let's just make it nice and simple, they're going to borrow that in 2027, the only option they are going to have is the new standard repayment plan. Okay. Now, again, before that, consolidation, I'm not going to touch on that today, but there are some ways you can get around a little bit of it, but not all of it. And for all of those that are not borrowing until that point in time, they have to plan on their only option being the standard repayment plan. And I say they need to plan that way because we know different administration, different Congresses, different, policymakers, things do change over time, but they need to borrow with the worst case scenario or the most restrictive case scenario in mind as far as I'm thinking. All right, I will take a break after this last little bit. So far we've been talking about new borrowers or people with a new loan after July 1st of 2026. But let's think about those students who are currently in repayment, okay? Current borrowers with no new loans, because remember, if you have a new loan, all of your loans have to be repaid under the same plan. So if someone borrows after July 1 of 2026, they're kind of like a new borrower because they have a new loan. So everything's going to have to be repaid under standard or RAP. But for those that are kind of done borrowing, they're just in repayment, they will continue to be eligible to enroll in the following plans. They can do the standard repayment plan that exists now. They can do the current income-based plans. They're actually old and new IBR. They can do graduated, extended, or the new income-based RAP plan. Okay. So, like my oldest son he's finished with school, he's repaying his loans. He has all of those options available. He's not borrowing any new loans, so he has those options available to him. Now, I'm sure a lot of you are wondering what happens to the borrowers that are currently enrolled in ICR, which is income contingent, or who are enrolled in pay, or who are enrolled in save. They are going to have to transition to a new plan. So these plans have been found to be illegal by the court. So these plans will just not continue to exist at all. Okay. So they are going to have to transition out of those plans and into a new eligible repayment plan. Now, current borrowers have more options available than new borrowers will have. So current borrowers have RAP, have the new standard plan, but they also have income-based repayment as an option. Okay, so there's old IBR and new IBR, and they will still continue to have that as an option, and they will continue to have that as an option as long as they enroll by July 1st of 2028, all the remaining way through their repayment. Okay. Those who are in SAVE, for example, because I know we have a ton of borrowers out there who are in SAVE. SAVE at the moment is in all of those students who have they're repaying their loans through SAVE. They are in an administrative forbearance. As of August 1st, though, they are having interest accrue on these loans. What I'm understanding and what I'm hearing is that SAVE is going to be going away at some point. So it's not like they're going to be able to start making payments under SAVE again. SAVE is done. It will stay in their loans will stay in administrative forbearance if they do nothing until a point in time, which we don't know when that will be, when they'll have to move to a different repayment option. So some borrowers, I put my son in this category, are moving into other repayment plans now because they just want to get their darn loans paid off. So you can stay in SAVE, you can just hold tight, but you do have interest accruing. It's not counting toward public service loan forgiveness either. Okay. So a lot of students and a lot of borrowers now saying, well, geez, maybe we need to think about making a change. So the people that are in ICR Pay and Save will have to transition to one of these new plans by July 1st of 2028. So a couple of different dates going around here. If they don't make that move on their own, they will automatically be moved into RAP. After all of the current borrowers move out of their current IDR plans or standard plans, they will be sunset. So eventually, the standard plan, where there's only 10 years, will be sunset. The IBR plans, the income-based repayment plans, the old and new IBR, those will be sunset eventually, but it will be a while because current borrowers can still take advantage of those as long as they are enrolled in those plans by July 1st, 2028. So we could do a whole presentation just on this. We may well do that in the coming, time once some of these things are clarified and these dates get closer. But we're definitely going to want to keep an eye on that. And we know this has a huge impact on borrowers. I'm just going to say one little thing because I know there were a couple years ago, I looked this up because I would get myself all turned around. IDR stands for income driven repayment. IDR is not a repayment plan. IDR is an umbrella term that includes underneath it ICR, pay, save, IBR, RAP. Okay, those are all different types of income driven repayment plans, but IDR in itself, there is no IDR repayment plan. Okay, so just in case that helps. All right, I'm going to take those questions now because I'm going to move into still loan stuff, but I don't want to get too far away from the questions that are being asked.
You want to read them or you want me to read them to you?
Let's see. I'll read them out loud to myself because that helps me take it in. Do you have to opt into the RAP plan? And will you be able to switch from the standard plan to the RAP plan if your financial situation changes several years into paying through the standard plan? So yes. So first of all, you don't have to opt into RAP, but if you have to change your plans and they will automatically put you into RAP if you don't take advantage. So if you are a current borrower, you want to assess the situation and decide what you want to do, because if you don't take any action, you will in 2028 be put into RAP automatically. Okay, but you've got time to make those decisions and see what's best for you. But the good news is you will be able to switch from the standard plan into RAP and vice versa. You will be able to move around the plans. There's no restrictions from doing that. Will existing Parent Plus loans, Plus loan borrowers be eligible for RAP if they consolidate under some circumstances? Okay. So I'm going to hold it at that. And if someone wants to reach out to me directly, I'm happy to just make sure I've got my ducks all in a row and put an answer in writing. But this is one of those areas where I feel like I don't want to give you the wrong answer. I know definitely they won't be going forward, but under consolidation, they they may be able to, but probably not if it pays off an underlying plus loan. Double plus consolidation, if anyone knows what that is going away as well, we believe. Okay, anything else? Okay. So I think we've got that one to the best of my ability, but do not hesitate to email me again if you want to talk more about that, because I'm happy to do additional research. And I have experts that I know that really are experts in this area, so we can get you those answers. All right, a couple of other things that are happening is that the economic hardship deferment and the unemployment deferments are going away. This is as of July 1st of 2027. So currently economic hardship deferments allowed borrowers to defer their loan payments for up to 36 months in 1-year increments. Unemployment deferment allowed borrowers working less than 30 hours per week and seeking to work to defer their payments for up to 36 months in 6-month increments. But as of borrowers who receive a loan on or after July 1st of 2027, these options just will simply not exist. Loan forbearance is another place that we're seeing some kind of pulling people back from the options that they had. That was not the phrased very well, Mila. Loans made on or after July 1, 2027 are eligible for forbearance for up to 9 months in any 2-year period. Currently, people can be in forbearance for up to 12 months at a time for a total of 3 years. So it's going to restrict how long someone can be in forbearance for, both in terms of, now down to 9 months from 12 months, but also the cumulative limit is going to go from 3 down to 2 years. Okay, so that's what we had on student loan borrowing, repayment specifically. Okay. Let's continue on. Let me just check my time here, see how I'm doing. Okay. So negotiated rulemaking is a really big deal. So a lot of things that we're not 100% sure of, even the experts aren't 100% sure of, will be addressed in negotiated rulemaking. So there's 2 committees. There's Reimagining and Improving Student Education. The RISE committee will address the loan issues. You can see that's coming up pretty quickly. So there is going to be 2-week-long sessions in person, September 29th through October 3rd, and then November 3rd through the 7th. And then the second committee is going to be the Accountability in Higher Ed and Access Through Demand-Driven Workforce Pell, the AHEAD committee. It will address the institutional and program accountability items, Pell Grants, and some other issues as well. And this is not taking place until the first week is in December, and then the second week isn't until 2026, until January. So that's why I think it's going to be really hard for Workforce Pell to be implemented on July 1st. Let's talk a little bit about tax code changes as they relate to 529 plans. These changes go into effect on various dates, but what is exciting, I think, and has great potential, so I wanted to share this with all of you that are working with students, is that the definition of a qualified education expense, which means that those earnings that hopefully people earn over time when they invest money in a 529 plan, those earnings are tax-free if they use them for qualified education expenses. So that definition was expanded as of July 4th, 2025. So basically on the date that the president signed the bill. So previously for K-12 students, the only thing that was an allowable qualified expense was tuition. But it is being expanded, and again, this is in effect now, for tuition, but also curriculum and academic materials, including online courses, books and instructional materials, tutoring services, although it does have to be someone who's not related to the student and they must be licensed. Standardized test fees. So students who are taking, AP for exams, for example, could use these funds to pay for that. They'd be a qualified expense. Dual enrollment college courses. So those students who, maybe are taking advantage of the courses they can take free, but want to take more than that, 529 funds could be used. They would be a qualifying expense. And educational therapy for students with disabilities. So this legislation applies to K-12 attendance or enrollment in a public school, private school, or religious elementary or secondary school. It does not apply to homeschooling, though. So that was another one where there was some discussion at one point in time in the House bill about covering homeschooling, but it did not. That came out in the final bill. The other thing that's going to happen is that there's going to be an increase on how much can be used for K through 12 expenses. As of today, the maximum is 10,000, but starting in January 1st of 2026, that's going to increase to 20,000. So if people are saving in a 529 plan, they could use up to $20,000 towards the expenses listed here after January 1st of 2026. Okay, here are some other things that I think are exciting. It adds certain post-secondary credential expenses to the definition of qualified higher education expenses. So we've talked about the expansion of the definition on the K-12 side, but there's an expansion when it comes to post-secondary credentials. So basically, if someone's pursuing a credential, their tuition, fees, books, supplies, and equipment required for enrollment in a recognized program is considered a qualifying expense. And again, that's in place now. Testing fees required to obtain or maintain a recognized credential. Continuing education fees necessary to maintain a recognized post-secondary credential program. Those are all qualified expenses. Now, these programs do have to meet certain criteria to be considered eligible programs. They have to either be authorized by the Workforce Innovation or Opportunity Act, WIOA, or be a military credential, or be aligned with other approved post-secondary credential organizations. So, more to come on this as well. Just a couple of things I wanted to also mention before we close for the day. There are some accountability things. I know that those of you who sit on college campuses have probably heard about this. There was a lot of stuff that was talked about that did not happen, but one of the things that they are looking at, and I think is a way of, having accountability and keeping debt down, is that it creates a new accountability measure that would cause a program to lose their direct loan eligibility. So those students in that program, not at that institution, this is at the program level, would lose their eligibility if the program fails the low earning outcome measure for 2 out of 3 years. So basically what that low earning outcome measure is that for undergraduate programs, it's going to compare the median income for the completers of that program. So it's not just people who went, for a semester and dropped out. It's looking at completers. But basically, if completers aren't earning more than working adults with only a high school degree or GED, that's going to be problematic, and potentially the school the students in that program will lose eligibility for their direct loans. Programs failing to meet this earnings threshold, for graduate programs, just let me say what it's going to do is it's going to compare the median earnings of 4-year post-enrollment. So those with a bachelor's degree, it's going to compare those to those that are working on their graduate degree and what their outcomes are. So it's going to have those two different measures, but in both cases, they have to be able to demonstrate that as a result of taking that program, these individuals are earning more than they would have had they basically not completed this program. Programs failing to meet this earnings threshold, 2 out of 3 years will lose eligibility to participate in the direct loan program, with an option to reapply after 2 years. After 1 year of failure, institutions have to provide disclosure to their students. So they'll have to let them know that they're at risk of losing their direct loan eligibility. And then this one, I am mentioning more because it's not as big a deal as I think it thought it was going to be, although it's a huge deal for a handful of schools. So this whole endowment tax on private colleges and universities, this will go into effect for the 2026 tax year. Now, again, it's private colleges and universities, so this does not impact public institutions. Currently, there's a flat 1.4% tax that is going to be replaced by a tax that gets progressively higher for those schools that have larger endowments. So basically, you can see what those numbers are. 8% for endowments that exceed oops, I forgot to add that back in, 2 million per student. I caught that last time, Jess, and I didn't catch it when I did my updates. So it's basically 2 million per student. So their endowment is more than 2 million per student. They're going to get taxed at 8%, which is significant. This is only applicable to institutions that have more than 3,000 students. Okay, so your small schools are not, really small schools are not going to be subject to this. So who does this really impact? Harvard, Yale, Stanford, Princeton, and MIT are the ones that are expected to pay that 8% rate. So that's huge for those schools. That is going to have an impact at those schools. And those schools are schools that offer amazing financial aid, meet 100% of need, often are, covering full tuition for students, even though their families might have a decent income. They have great financial aid. So we'll have to watch whether this has an impact on that or their staffing. Notre Dame, Dartmouth, Rice, University of Pennsylvania, Washington University, and St. Louis and Vanderbilt would be expected to pay the 4% rate. And then there are a couple like Duke and Emory that are on the border of that. So I wanted to share this because most schools do not need to worry about this, but if those schools are on a student's list, they are going to, really need to see what impact this could have on them. I know schools don't want to reduce financial aid, and they will avoid it if they can, but we'll need to see what happens. And last but not least, I just wanted to mention a few things that were not in the bill. So they were in the House bill, but they were not in the final bill that was signed by the president. The Senate made some changes to that. So Pell Grant enrollment, there was a point in time where there was going to be a change to the definition of full-time for Pell Grant eligibility. Currently, and continuing, a student is considered full-time for Pell Grant purposes if they're taking 12 credits per semester. There is a proposal that they'd have to be taking 15 credits a semester to be considered full-time, and that did not end up happening. So that's, I think, good news. There was also a proposal to eliminate less than half-time Pell. That did not happen, so less than half-time Pell is still available. There was the potential at one point in time that subsidized loans were going to go away, and there would only be the unsub option. So currently, only undergraduate students have an option to borrow a subsidized loan. They did away with that at the grad level several years ago, probably a decade ago now. And there was some fear that that was going to happen. It was in some of the language that it was going to go away for undergraduate students, but that did not happen. So undergraduate students are still eligible, depending on their circumstances, for up to $3,500 in a subsidized loan first year, 45 that second year, 55 their junior and senior year, and then that's supplemented by some additional unsub. And then there were some provisions that would have resulted in non-U.S. citizens who are currently eligible for federal financial aid. We have a whole swath of eligible non-citizens. There was some concern that those were going to go away, and current eligible non-citizens would not be eligible for federal financial aid, but there's been no changes to the citizenship criteria. So what is in place today, what was in place 6 months ago, is still in place when it comes to determining whether or not a student is eligible for federal financial aid. And I'll just say really quickly that on our website at famaine.com/newmainers, we do have a little where you can put in it will ask you different questions, and you can determine whether or not a student is eligible for federal financial aid. So if you're ever curious about whether someone is or isn't, that's a handy way to easily determine whether they meet that criteria. All right. So that is what I had. So Jess, I could see we have a couple of questions.
Yes, and I'm trying to remember. Sienna asked about social work programs being eligible, and I'm trying to remember, Sienna. It wasn't the first time you talked about the professional. It was in the repayment part, I think. Sienna, can you remind us in what scenario you are asking about the social work programs while she gives us that information?
Yeah.
We have another one that says, how will the change to Pell Grant disbursement impact students that may have been receiving both Maine Free College and Pell Grant?
Yeah. Well, that's a scenario where we've had students in the past who have had, full Pell, Maine State Grant, And Worthington, who I think the underlying question is, would those students not get their Pell Grant if they have other sources of aid? So I think we have to see how that works out. But one of the things that I think this gets to is that the way free college has worked, and free college is continuing for students who have already graduated, it's just not continuing in the future, is that students weren't getting their full Pell Grant and getting the free college scholarship on top of it. Those students had to fill out their FAFSA, and if they had Pell Grant that covered the cost of their tuition and fees, then that's what covered the cost of their tuition and fees. They did not get, the free college scholarship on top of that. Okay, so that scenario didn't actually is doesn't exist. So there's no risk to that going forward. But I will say at community colleges, we do sometimes have students that have really great outside scholarships. And they have a Maine state grant and they might have a full Pell Grant. So we will be watching it from that perspective. The accountability measures. So I think, let me go back here and look at this because I think this will be. So yeah, I mean, I think that there are programs that are going to be at risk. There are programs where students don't graduate and have significant earnings. Now, I would like to think, I hope to goodness, that students who are in like social work, for example, that they are earning more than, a student who didn't go to school at all. But I think what the underlying question might be here is that often to be a social worker, you've got to go to graduate school. So as you complete graduate school, are those students earning more than the average student who had a 4-year degree? And I don't know what those numbers look like, but these are things that are going to be discussed. And I think that some of these professions that require a lot of education but don't have particularly high aren't going to produce particularly high earners are potentially going to be at risk. But much more to come. So no reason yet, to get too concerned. We've got a lot of definitions and determinations that are going to need to be made. But for social work, I think it is a great example of where there could be an impact. Right.
Great. And one more, someone curious about whether they will take into account the average wage of different careers.
I don't know.
Yeah.
I hate saying that. I don't know. So I think that where we're going to see that is in that negotiated rulemaking. And what I'm going to say is, I don't know if I don't know just because I don't know, or I don't know because it's not yet been determined. So I think that that negotiated rulemaking that takes place in December and January is where a lot of those details will be clarified. So hold tight. This will not be the last webinar we do on these topics. I think probably what we'll do is, as things become revealed through negotiated rulemaking, we will do more of these sessions and focus in on specific areas. This was kind of a high level overview, but we'll get more into the weeds as we have more details. So with that,
I
I'm
think we
going to
got it.
stop recording. Let me stop recording and